Alright, good morning ladies and gentlemen. In this video, we will review the fourth quarter earnings that we have received from certain companies last week. I did an earnings preview video. We discussed our expectations and some of the technical analysis for certain names. So in this video, I will update you with the results, my analysis, and updates on the charts. And here is a review. Of course, we were talking about some earnings we received the week before, specifically for JP Morgan, Citibank, Wells Fargo, and Delta Airlines. And last week on Tuesday, we received earnings from Bank of America, Goldman Sachs, and Netflix. Then on Wednesday, we got the reports from Proctor & Gamble, United Health, Morgan Stanley, and United Airlines. And lastly, on Thursday, we received earnings from Union Pacific, Intel, and IBM. So let's start with reviewing earnings from Bank of America. And if you remember, during the preview video, we discussed what I'm looking for during my analysis for bank earnings. I'm trying to assess the financial health of these firms in these unique times of the pandemic. So these are not the typical key metrics I'm looking for when I review bank earnings. But given the specific times that we're in, these specific key metrics become very, very important because when making an investment decision on which bank to invest in, the outlook for the financial health of each bank becomes very, very important. And the metrics are the return on tangible equities, the efficiency ratio, the reserve releases, the allowance for credit losses, the revenue growth year over year, the net interest income year over year, and lastly, the revenue from the consumer banking segment year over year. I think these metrics are very, very important. So let's see how Bank of America did during the fourth quarter. And here are the numbers. The ROTCE for Bank of America came out at 11.7%, the efficiency ratio at 69%. And remember, the closer you are to 50% and below, the better. Meaning, the higher the efficiency ratio, the worse it is. So we're looking for a lower number here. What about the reserve release? Bank of America released about $800 million during the fourth quarter, and they still have about $11.3 billion in their allowance for credit losses. And it is a little less than other banks because they have a lot of cash positioning on hand. What about the overall revenue growth or lack thereof? Bank of America, the revenue decline 9.8% year over year. What about net interest income? Also down about 15.6% year over year. What about the consumer banking segment? The revenue was down 13.37% year over year. And now that you have the full picture for banks' earnings, let me ask you a question. Which bank would you like to invest in? This is the beauty of doing this analysis to make it clear for you when we assess the health of all of these banks. The choice could not be any clearer. JP Morgan is the best performing bank across the board. They managed to have positive revenue growth year over year in a very, very difficult year. And remember, they have over $30 billion in their allowance for credit losses. This is a very conservative approach from the management at JP Morgan. They could release billions and billions of dollars and use that money for share buybacks or writing new loans. So once again, JP Morgan has a massive advantage over the rest of the banking names. Next, we received earnings from Goldman Sachs, and let's see how they did. We are looking for massive numbers here, given all the trading mania that is going on in the stock market. And check out these numbers. The investing banking segment for Goldman Sachs grew 27% year over year. The global market segment grew over 23%, while the asset management segment grew 7%. And lastly, the consumer and wealth management segment grew 17% year over year. And the overall picture here in terms of revenue, 18% growth year over year. And what about net earnings? Check out this number. The net earnings for Goldman Sachs grew 135% year over year. Monstrous numbers as we expected. And let me show you something here when we talk about all the trading mania that is going on in the stock market. Where is the money going? Here is the answer. Specifically, when we talk about the IPO mania, equity underwriting, the revenue from all of the IPO writing that Goldman Sachs did was up 195% year over year. Unbelievable growth for Goldman Sachs. So how did the stock react to these very positive earnings? Before we do that, let's review what I said a week ago during my preview video regarding Goldman Sachs. The problem is, when you look at the chart, Goldman is already very extended. It has been on this very violent vertical rally. And of course, before the breakout from the resistance line, I recommended buying Goldman Sachs stock, and I have already exercised my options to buy the name. So I already own Goldman Sachs in my portfolio. And here is what I'm looking for. I am looking for a pullback because however impressive the numbers will be from Goldman Sachs, that is already priced in. It will take an unbelievable surprise to the upside in terms of earnings to sustain this rally in Goldman Sachs. So on Friday, after I saw the decent results from JP Morgan, yet the stock reacted negatively, I bought some put options expecting a pullback here in Goldman Sachs, just to protect my shares. So we are expecting a pullback here in Goldman Sachs, yet the results will be very, very impressive. And here is how the chart looks. We saw a down day, and my decision was correct to buy puts for this name to protect my shares because we saw declines for Goldman Sachs even though the earnings were great. Next, we received earnings from Netflix, and here is the take. Let's discuss the regional performance first. And by the way, Netflix do not provide PowerPoint slides. They provide you with the Excel sheet, so I had to create these slides from scratch for you, just to illustrate to you the important things to look at when you are reviewing Netflix's earnings. And when we talk about revenue growth, geographically, North America was up 14%, Latin America up 13%, Europe, Middle East, and Africa up 40%, and check out this number, Asia Pacific up 61% year over year. And we are talking about the annual revenue growth because this is a reoccurring billing company. So there is no point of looking at the fourth quarter of 2020 versus the fourth quarter of 2019. We'll look at the entire year altogether. Similarly, when we talk about paid subscribers growth, this is the important number. We're looking for subscribers who are paying, not using free trials, etc. In North America, the number was up 9.3%, in Latin America 19.5%, and in Europe, Middle East, and Africa up 28.8%, and lastly in Asia Pacific up 57%. What about the revenue per subscriber for each region? In North America, the average revenue was $13.32. In Latin America, $7.45. In Europe, Middle East, and Africa, $10.72. And lastly, in Asia Pacific, the revenue per subscriber came at $9.12. The moral of the story here is, while Netflix is maturing in the North American and Latin American markets, they are still experiencing massive growth, specifically in the Middle East and the Asia Pacific region. What about the income statement? The revenue overall was up 24% year over year, and the net income was up 48% year over year. Big numbers for Netflix. However, this is according to Netflix's management, not according to me. We will not see these numbers again. This year was very unique due to the pandemic. A lot of people staying at home. They had no choice but to subscribe for Netflix. So we are likely not going to see these numbers again. So we have to look at other metrics to evaluate the financial health of Netflix. And for that, we're looking at the free cash flow. In 2019, they had negative cash flow of over $3.3 billion. In 2020, check out this number. The free cash flow was positive $1.9 billion. Unbelievable number, and this is why the market celebrated and you saw the stock shooting up significantly, because Netflix for the first time ever produced a positive cash flow for the entire year, and there was unique circumstances behind the positive cash flow. It's not the growth in revenue or net income. There was something else. I'm about to discuss it with you. But before we do that, let's play the devil advocate and check out if there are any signs of warning here in Netflix's earnings, because that's what a good analyst would do. A bad analyst would just go over the numbers, present them, and say, all right, these are good numbers, let's celebrate. However, a good analyst will look for pockets of strength and weakness where others are not looking. So what am I seeing here? Check out the net income growth year over year, all the way from the second quarter of 2020 to the fourth quarter of the same year. During the second quarter of 2020, the net income growth year over year was 266%, massive number. In the third quarter, that number was reduced to 18.75%. In the fourth quarter, the number was down. The net income was actually negative, minus 7.63%. Why is this number important? Because we have a trend of a declining net income. What is the reason behind that? Netflix is on a spending spree to produce a new movie every single week, and they're producing a ton of content internationally, not just in the United States, in different languages. And they are unfortunately hiring these big superstars like The Rock, etc., and they're paying them hundreds of millions of dollars for content. All of that will add significant pressure on the margins for Netflix. So the question is, are we going to continue to see negative net income growth year over year for the next few quarters? That remains to be seen. It depends on how efficient Netflix is going to be with their spending. Do you really need to spend $500 million to create content from The Rock, Dwayne Johnson, or is it more efficient to create a blockbuster hit such as The Queen Gambit with a fraction of the investment? That is all up to who? Ted Sarandos. He's the man who's making the decision on the top of the pyramid at Netflix. Now here's the other number I want you to look for. The foreign currency reimbursement on debt. In 2019, the number was minus 45.5 million. In 2020, the number was positive 533 million. Why is that important? The bulk of the positive free cash flow that Netflix experienced during the year came from the currency effect, meaning that the decline in the US dollar was very, very good for Netflix earnings. Because remember, they are growing internationally. And if the dollar is so strong, once the exchange effect takes place from the foreign currency to the stronger dollar, those revenues and earnings get diluted. However, if we have a weaker dollar, all of that revenue from foreign currencies is now more valuable when you pin it to a lower US dollar. And therefore, we saw Netflix experiencing a positive cash flow. So that is the take. For now, the decline in the US dollar is very, very good for Netflix. However, if they are going to continue to produce content internationally, specifically where the growth is Middle East and Asia Pacific, they're going to have to exchange the weaker dollar to the stronger currency overseas and produce that content. So while the revenue from overseas will be very good for Netflix, if the dollar continues to decline, the cost of producing that content will dilute the positive effect of a lower dollar. Now let's review what I said about Netflix chart before earnings. If you're going to trade this via options, my recommendation is use calendar spreads. If you're bullish on the name and you're betting on an upside breakout from the consolidation wedge, use call spreads, specifically calendar spreads. Likewise, if you're bearish on the name, betting that the breakout is going to be to the downside, then I recommend using calendar puts. And the reason is you're taking advantage of a short week of trading, elevated premiums, and you're giving yourself a little more time for the trade to work. And here is the update. We were consolidating in the wedge formation. The break was bound to happen one way or the other, up or down. And of course, after these monstrous numbers, you gotta believe that the break is gonna happen to the upside. And that is exactly what happened. However, the stock closed the week below the highs. We will see if Netflix will continue the momentum, or we will see more cash being deployed to buy Netflix shares, or are investors going to look at the spending that Netflix is doing and they will say, well, the earnings were very good. However, I'm concerned about how much they're planning to spend. We will see what happens. And moving on to the earnings we got last Wednesday, starting with Procter & Gamble. And let's see how the company did. In terms of revenue, the growth was 9% year over year. In terms of net income, the growth was 19% year over year. Significant growth. And let's check out the different segments for Procter & Gamble and how they performed. The beauty segment was up 7% year over year. The grooming segment, 5% year over year. The healthcare segment was up 11% year over year. But the most impressive gain came from the fabric and home care segment, up over 14%. There's no surprise here, People are staying at home, they're doing the laundry right at home, so they need to buy Tide detergent, etc. What about the baby, feminine, and family care segment? Up over 3% year over year. And let's review what I said about the chart last week. Furthermore, from a technical perspective, we have a head and shoulder formation, and I am looking for the name to break below the 135 support. You have to keep in mind the following. This is sort of a dividend aristocrat as well. If we have an increase in inflation, an increase in interest rates, in terms of the 10 years treasury yield, these names become less and less attractive, and combine that with the fact that some insiders such as Nelson Peltz been dumping this name significantly. Nelson Peltz been holding the name for a long time. All of a sudden last year he decided to dump. It is worth it here to make a bearish bet against Procter & Gamble by buying put options. I see a break to the downside for this name. And here is the update. The chart reacted exactly as I expected. And the reason is, while the growth is very impressive, we're about to transition from the stay-at-home to the reopening phase of the recovery. That makes Procter & Gamble an investment of the past, meaning last year, and we will see that home and fabric segment growth declines as people start to go out doing laundry outside. And the question is, will the growth from the home care segment migrate into the beauty and grooming segment once people start to go out? That remains to be seen, but all in all, the stock was trading at very elevated levels. All of that growth was already priced in, and therefore you saw the chart reacting negatively. Next, we have United Health, and here are the results. The revenues grown from 60.9 billion to 65.5 billion year over year. What about earnings? For 2019, the earnings were 5.1 billion. In 2020, earnings were short at 3.5 billion. So we have negative growth in terms of net earnings. Why is that? Let's break it by segment. While the health insurance segment revenue grown year over year, the earnings declined year over year due to reimbursement and special provisions for the COVID-19 crisis. They had to reimburse a lot of their clients. They did not want to charge them for certain services. If you got sick, if you got to the hospital after you were infected from COVID-19, of course there was a deal that insurers are not going to charge you for the treatment. But rest assured that the other segment for the company, the Optum X, this is the pharmacy segment, did indeed grow in terms of revenue and net income year over year. So let's review what I said about the chart for this company last week. And that could add pressure to United Health stock. Remember that the stock is trading pretty much at all-time high. So the expectation here for impressive results, any disappointment to the downside, and you will see the name reacting very negatively. And indeed, the chart reacted as I expected, trading to the downside, and perhaps we will see more profit taking in the weeks to come. Next, we have Morgan Stanley. And we just discussed Goldman Sachs, so you can pin Goldman's numbers with Morgan Stanley. Both had impressive results. However, Goldman, in my opinion, outperformed Morgan Stanley. Morgan Stanley, the net revenue has grown year over year from 10.8 billion to 13.6 billion. In terms of net income, that has grown from 2.2 billion to 3.3 billion. Very, very impressive numbers for Morgan Stanley. And how good was the IPO mania to the earnings of Morgan Stanley? Here it is. The equity underwriting, the revenue last year was only 422 million. This year, it came at an even $1 billion. That is more than double the revenue from last year. Similarly, when we talk about trading revenue for equity, this is the whole gambling mania that is going on in the stock market. That number grown from last year, 1.9 billion to 2.5 billion dollars. All in all, very, very impressive results for Morgan Stanley. Next, we have United Airlines. And once again, this time around for the airlines, we're not looking for revenues, net income, bookings, mile per passenger, revenue per seat. We're not looking about any of that because we know the business is bad. So we're looking for the financial health and standing for these airline companies. And I'm using three metrics here. We discussed them last week when I reviewed Delta's earnings. The cash burn number, this is the daily cash burn, and then the short-term maturities. We want to know the immediate obligations for the company, and then how much cash they have on hand. And for United, the cash burn number came out at 33 million per per day. Meanwhile, their short-term obligations at 2.7 billion and the cash they have at hand at 11.7 billion. Now look at Delta versus United. Which company would you rather investing in? The answer is, it's very clear. Delta Airlines. The rate of cash burn is much lower. They have a lot of cash in hand and they can handle their short-term maturities a lot better than United. Of course, we're waiting on Southwest this week and American Airlines the next week. And moving on the earnings we received last Thursday, starting with Union Pacific. And here are the results for Union Pacific. And we are looking at the adjusted number because there was an impairment charge for Union Pacific this year. I highly recommend that you look up what impairment charge means because it is related to writing off goodwill from previous acquisitions. And it is very tricky to evaluate whether that is good for the company or not. There are certain things you need to look for before saying that this is good or not, because it is also an indication whether management made a bad decision in the past by overpaying in their previous acquisitions during times of bubbles. But in this case, the earnings per share grown 17% year over year, and they are saying that they have a very good operating ratio number. This is, of course, how much are their expenses in relation to their sales. But once again, the impairment charge distorts the reported numbers versus the adjusted numbers. So it is very critical for you to review what impairment charge means. And the beauty of reviewing Union Pacific earnings is not just to assess the health of the company, but to assess the health of the overall economy. We want to know which goods are being transported, what about the volume, which sectors of the economy are growing versus declining, and here are some numbers. As you can see, the bulk segment for Union Pacific, transporting coal and renewables, was down year over year, 16%. However, grains up 20% year over year. You saw the prices of grains skyrocketing, whether we're talking about corn, soybeans, canola. So it is no wonder why that grain transport grew year over year. And you can see the numbers for fertilizer, food, and refrigerated goods. And then when we shift to the industrial goods, let's see what's going on here. Energy and specialized down 16% year over year. Forest products, this is for lumber, up 11% year over year. Industrial, chemicals, and plastic, pretty much flat. Metals and minerals down 7%. That one is a little surprising considering the prices of metals. What about the premium segment? Automotive down 3% year over year. Meanwhile, the intermodal segment up over 12% year over year. And here is the overall picture. The weakness is coming from coal, energy. That is not surprising at all, considering what's going on with all the shutdowns and the bankruptcies for domestic energy producers. And once again, here are the numbers for Union Pacific. The operating revenue was down 1% year over year. Meanwhile, the net income was up 13% year over year. And once again, we're talking about the adjusted number here due to the impairment charge. And the last thing I want to show you for Union Pacific earnings, if you are interested in railroad investing, these metrics are very important. You need to look at the report for Union Pacific versus any other company you're debating whether to invest in versus Union Pacific. These key metrics are very important for the railroad industry. And let's review what I said about Union Pacific chart last week. When it comes to the technical analysis for the stock, Union Pacific has been on a very defined upward trend since 2016. It is very elevated from the trend line right now. And every time it did that, it went back to retest the trend line for support. The thing to watch out for here, that even if we have good earnings for Union Pacific, it could go down and do the technically healthy thing of revisiting the trend line for support. And here is the update. The chart reacted exactly as I expected to the downside, and we saw losses for Union Pacific, even though their earnings were not that bad at all. But the name is very stretched and elevated, and it is time to take a break. What about Intel? What's going on here? The revenue overall was down 1% year over year. Meanwhile, the net income was down 15% year over year, and that is due to the increase in tax rate So all of you who keep saying, let's rally on the Biden optimism, on the high taxes optimism, this is what high taxes do to companies' earnings. When we talk about a company that is struggling to begin with, such as Intel, there's no wonder why. High taxes, even the slimmest margin, could hurt the bottom line severely. And let's review the two most important business segments for Intel. The data center segment was down 16% year over year in terms of revenue and 40% in terms of operating income. Massive declines, and you know that AMD and Nvidia are eating Intel's lunch, and the picture is getting very dire for this company. But perhaps there is a bright light in the other business segment, the client computing group, aka the chips, the core business of the company. When we talk about the revenue, that was up 9% year over year. Meanwhile, the operating income was up 10% year over year. And the bulk of the growth came from notebooks, up 30% year over year. There's no surprise here. During the pandemic lockdowns, people are buying new notebooks. Intel chips happen to be there. The sales increased 30% year over year. Meanwhile, the desktop segment was down 6% year over year. Now, this is still very concerning because the notebook trend is very specific to the pandemic lockdowns. What happens when we return back to normalization? These numbers are going to go down, and we have to address the weakness in data centers. The management at Intel have a very tough task to handle here. This is a name that is very cheaply valued. However, the challenges are very big. And let's review what I said about Intel Chart during last week's video. All the good news are already baked in. The announcements that we were supposed to get during the conference calls and the earnings releases, the Bob Swan, the CEOs leaving, a new management is taking over. Perhaps we have more intervention here from activist investors such as Dan Loeb, of restructuring the company. All of that has already been priced in, and you saw the massive move higher for Intel the last few weeks. So the risk is to the downside here. If the numbers are not improving in the fourth quarter, and we're still seeing Intel suffering specifically from a pricing perspective, remember, we have a chip shortage here, so that should be a tailwind for prices to go higher for these semiconductor designers. If the numbers are not good and we're heading in with this massive move in the stock, the risk is to the downside here. So if you own the stock, you might want to take advantage here by selling upside calls and perhaps using some of the proceeds and buying some put options for protection. And the chart reacted exactly as I expected, even though the name rallied higher into earnings. Of course, we have an incident where earnings actually leaked before the closing bell on Thursday. And what happened is a call options buying frenzy. Unfortunately, with this environment in the stock market, the gambling that's going on, as soon as one slide of earnings leaked without even reading the slide, these morons went on and they bought call options like there is no tomorrow. And you saw the last 15 minutes volume in Intel's chart during the trading day of Thursday spiking significantly higher. And then after earnings, the name collapsed about 10%. All in all, if you use the strategy that I suggested of selling upside calls and then buying a put with some of the proceeds, you did extremely well. Now, if you thought Intel's earnings are bad, buckle up your seatbelt because here comes the worst. IBM. And here are the earnings. At first, when you look at their presentation, they present you with this slide. And when I review companies' earnings and they present you with a slide like this at the beginning, throwing opportunity numbers and the overall market value, in my head, I'm thinking, okay, what are you hiding here? Show me the numbers, baby, because I am a numbers kind of investor. I'm not interested in stories, hopes, dreams. I'm interested in numbers. And there is a good reason to hide those numbers because they are pathetic. Let's talk about the Cloud, Cognitive, and Software business unit at IBM. The revenue down 7% year over year, and the reason is the transaction processing business is down 26% year over year. Meanwhile, the Cloud and Data Platform, this is the Red Hat segment, was actually up 6% year over year, but the decline in the transaction processing segment was too severe. And the question here for the new management at IBM specifically CEO Krishna. You got a lot of fat in this company to trim. There are a lot of business units here that are too old, not growing at all, and they're just siphoning growth from the company. However, this is not an easy challenge because this is a dividend-paying company. It's an old-school cash-generating company. And the bulk of the cash is coming from these old-school units, not the growing units. So Krishna has a massive task on his hand to manage here. He has to thread the needle very, very carefully. And by the way, here is his strategy. Hybrid cloud and AI strategy plus action to accelerate change, and that will drive growth in the future. I'll believe it when I see it because this quarter was very, very bad. With that being said, the company actually generated about $15 billion in cash. So the dividend is still safe. This is a company that is still generating an impressive amount of cash. The problem is that any avenue of growth that they have is being closed by these old business units that are just sitting there and not growing at all. And to illustrate that for you, here is the next business segment for IBM, the Global Businesses Service. The revenue was down 5% year over year, and the bulk of the pain came from application management, down 9% year over year. Consulting was down 3% year over year. That is not a big deal. Meanwhile, Global Process Services was up 4% year over year. Here was the ugly. The systems business unit down 19% year over year. We're talking about IBM Z. What a disaster that was. The systems hardware. This is another old school business. Generating cash, yes, but not growing at all. Matter of fact, down 20% year over year. Likewise, the operating system software down 14%. And the message for Krishna here, this is a business segment that you have to trim some of the fat from and concentrate on the growing aspects of the business. Here's the last business segment for Global Technology Services. Down 8% year over year. We talk about infrastructure and cloud services. Down 8% year over year. Technology and support services down 7% year over year. Bad numbers across the board. No wonder why the shares reacted the way they did. And by the way, let's go back and review what I said about IBM's chart during last week's video. IBM has been on a steady decline for years now. It is a quote-unquote value name, not a growth name. And we are in an era where value names are not appreciated, but we are starting to change here from the growth era to the value era. And this makes IBM one of the top names I'm picking for 2021. And you see the resistance line, this descending line that has been going on since 2017. And every time we attempted to break above the trend line, we were met by a failure. We're getting very close here to break above that trend and create a new positive upward trend in IBM. We already made a lower low for the March lows, and we are heading to crack the descending line and create an upward trend for IBM. This is a very underappreciated name. Remember that they have acquired Red Hat a few years ago, and that is supposed to be the growth engine for IBM. We've been waiting and waiting and waiting to see when the Red Hat growth is reflected in IBM's earnings. Perhaps this quarter is it. I am positive on IBM. I like the name, and the way I'm playing this one is buying naked calls, and if the name cracks above the descending line, I will exercise those calls and add shares of IBM to my portfolio. And the reason why I'm doing this instead of buying the stock right away, what if there is a negative surprise during the earnings report and IBM reacts negatively? I'm reducing my risk by buying call options instead, and if the result I'm looking for happens, I will just exercise those options into shares. And boy, that did not happen. The opposite outcome took place, and you saw IBM shares declining about 10% or so, stopping at the support level that I have identified for about 117.8. Now, I want all of you to pay attention here, specifically stock investors who are curious about options trading, but they're still intimidated and not sure why they should use options. Remember what I said, I bought call options instead of buying the stock ahead of earnings to reduce my risk. This is the main purpose of options as a tool of risk mitigation. Options were not designed for market participants to gamble like you're seeing right now in the stock market. They were designed as a risk mitigation tool, just like I used it with IBM stock last week. Example, had I bought 100 shares of IBM ahead of earnings, I would have paid $13,000 to buy 100 shares of IBM. And after the stock declined 10% after earnings, I would have lost $1,300. Instead, I bought call options for about $1 a piece, which translates to $100 for the contract that I bought. Each contract has 100 options. Each option represents one share of the stock. So all in all, my losses, since the trade did not go my way, are limited to the $100 I paid to buy the option. Would you rather lose $1,300 or $100 to take the risk? This is a perfect use of utilizing options as a risk mitigation tool. And that brings us to the end of this video. We reviewed all the earnings that we received last week, at least the important ones that I'm highlighting for you. We do have a new round of earnings coming up this week, and I have a video previewing those earnings, and we will review them once again after we receive them. I hope this video was very helpful for you. If it was, return the favor by pressing the like button, subscribing, and leaving a comment if you have any further questions. Thank you so much. I'll talk to you again soon.